So I guess well, let's kick it off with private equity basics. And I'm going to ask you a question that's
Yeah.
far too broad that I shouldn't even ask. But so just it's from what I heard, private equity is now a $6 trillion industry. I'm sure that number
Mhm.
fluctuates.
Yep.
Can you explain high level what is private equity?
Okay. Um, it's sometimes it's easier to explain what it is by telling you what it's not, right?
Okay.
So let's broaden out a little bit more even. So I'm going to talk about private markets in general.
Mm,
So this would include not just equity per se, but bonds, right? So here's what it's not, right? So what your investors are probably used to are public markets, right? So where you invest in the stock of like Nvidia or Apple or the bonds of
mm,
GM or IBM, right? So these are public equity and public bond markets.
mm.
Um, it's not that, right? So the public markets are one in which you can, watch CNBC and you can, buy the individual stocks either directly through, an online broker or through their financial advisor. Um, Private markets are not publicly available,
Mm.
right? That is, you have to go through some intermediated platform or advisor to get access to them. And it largely breaks down to three sort of categories, right? So private equity being the largest among them, and that's very similar to its public equity market equivalent, except again, it's not publicly available, right? So these are privately held investment companies. Then there's also private credit, which has been growing lately, and sort of another bucket of private real assets, which would include real estate, infrastructure investments, even things like farmland and whatnot.
Mm.
So private equity being the largest of them, they all basically have the same structure. So I'll talk primarily about private equity, right? So they tend to raise money from institutions or high net worth investors that they use to take that capital to buy small businesses, private businesses, sometimes even public businesses they take private, right? So there's, call it three main categories, if you will, in private equity. There's the bigger traditional one we think of as what's called leverage buyouts, where you might, see a struggling firm and you buy the firm wholesale. And if it's public, you take it private
Mm.
and you lever it up with debt on the firm's balance sheet and try to improve operations and then sell it some years down the road, typically, 3 to 7 years later. Then there's venture capital, I'm sure people have heard of, right? These
Right.
are, like your Shark Tank, and you go on Shark Tank and try to raise money from, Mark Cuban
Right.
and Mr. Wonderful. And these are for early stage startup companies, right? So still private investments, but still from an equity perspective. And equity is differentiated in many ways in that you're the last person, like you're an owner of the firm and some pro rata share of that firm.
Mm.
And you just take whatever's left over in terms of cash flows after everybody else has been paid for, right?
Mm.
The third main category, which has been growing over the last decade, is something called growth equity. So it sort of sits in between venture capital and a leverage buyout, which, a leverage buyout would be more mature companies. Growth equity is sort of in this scale up phase or, a growth phase of the company. In years past, companies would start in the venture capital phase, right? And then, the private equity manager, which we'll talk about in a minute, would then spin them out through an IPO to the public markets.
Mm.
There's more and more interest by these companies like Shopify or even ByteDance to stay, private, so they get more growth equity from the private markets and stay private for much longer. And you see this even now with OpenAI, right, who runs
Mm.
ChatGPT. They're still private. And so those are the three main categories: venture capital, growth equity, and LBO. Now, in terms of how they operate, right, the we'll talk about a bit about the sort of the individuals who run it, right? So I mentioned that you have institutional investors typically, who would come in. And by that, I mean like university endowments and foundations and insurance companies.
Or like, could it be even our pension funds, right? The employee retirement
Absolutely.
system, stuff
Yeah.
like that.
So, for example, the Hawaii Employee Retirement System, right? They have, something like 20% of their portfolio invested in private equity funds,
Mm,
right? So yeah, absolutely. Pensions are particularly large investors in these fields as well. So they would be the investors. They're often called limited partners or
mm,
LPs. And they make commitments to a general partner, a GP, who runs a particular fund. All right. So this might be like Blackstone, one of these major large private equity fund managers, or Apollo Group, who raise a fund from different institutional investors or high net worth individuals. And typically the buy-in to these funds is in the millions of dollars, right? So you have to commit maybe $10 million to the fund or five, something in that range, quite large fund amount.
mm.
And what the GP then does is invest that money typically over the business cycle. So the money is committed over roughly a 10-year, on average, time period. So there's essentially no liquidity when you commit to these funds.
Right.
So that's one of the downsides, but that's also one of the upsides in that, by locking up your capital, you get what's called sort of a liquidity premium, as it were,
Mm,
right? So you should expect to receive more, right? No risk, no reward, right?
sure, sure.
So that's true also in terms of locking up your capital. So they'll, do their best to find the GP that is will then go do their best to find underlying small firms or medium-sized firms to essentially improve their operations over time. So they buy the firm, improve operations, and then hopefully exit that firm through a sale to the private market or take it public potentially, or even sell it to a strategic, meaning like to another public company already, right? And that typically takes, 3 to 7 years through the sort of business cycle. And so what's unique about this structure is that the institutional investor and the high net worth individuals who commit this capital, let's say you commit $10 million to a fund. Well, you don't actually hand over that $10 million on day one, right? The GP still needs to go out in the world and find good investments.
Mhm.
So over typically the first 3 to 5 years of the fund's life, they'll occasionally call and say, "Hey, we have a great investment we're going to make. We're going to call 1 million of those dollars that you committed." So it's at that point in time where you actually fund it. So one of the great challenges to investing in these funds is that they have to, account for the fact that you might get a call any day of the week, right? And you have to fund that commitment over the next quarter. So it can be challenging from a cash flow perspective. And so they go, hopefully, make good investments. And then on the back end of that, you'll see all your payoffs, right? So typically you'll see all these drawdowns in the early part of the cycle. So you see only negative returns on your, your
Right,
balance
right.
sheet. But then over time, over that 10-year cycle, hopefully those improve. And it's very similar in many ways in private credit markets, except instead of investing, you're taking equity stake, you're actually making loans to companies, right? You're
Mm,
making loans to middle market companies that maybe not large enough to get preferential bank loans, right, from your traditional lenders,
mm.
or even access the bond markets. Maybe they're too small for accessing public bond markets, that is to issue a bond. So there's many reasons that those funds exist. And then, of course, there's like as I mentioned before, the real assets, right? So investing directly in real estate.
Right.
There's specific funds that do that as well.
The opinions and statements presented on this show are for general information only and are not intended to provide specific advice or recommendations. Never make any investment or financial decisions based on information offered on this show without first consulting your financial, legal, or tax advisor. All economic and performance information mentioned on the show is historical in nature and is not indicative of any future results. All indices mentioned on this show are unmanaged and cannot be invested in directly. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Lastly, all opinions expressed by Jason Cutitta and any guests on the show are solely their own opinions and do not reflect the opinions of or are endorsed by ToBA Financial. For Jason Cutitta, investment advisory services are offered through ToBA Financial LLC, a registered investment advisor offering advisory services in the state of Hawaii and in other jurisdictions where exempt from registration.